Ever wondered how money pros like Buffett and Graham figure out what a stock's really worth? They use a simple trick called discounted cash flow analysis. Join us to learn this trick, understand a stock's real value, and make smarter investment decisions. Keep watching until the end of the video to see how to calculate the intrinsic value of a stock. Trust me, you don't want to miss this. Before jumping in, let's take a minute to understand why we're doing this and what it means. Simply put, we want to make sure we're not paying too much for a stock. So what we're doing is looking at the business as if it's a cash-making machine. Now, let's dive into figuring out a company's real value. Think of it like this. The true worth of a business today is simply the total of the money it's going to make in the future, but accounted for in today's terms. This idea was proposed by a well-known economist named John Burr Williams and is frequently referenced by the renowned investor Warren Buffett. I know it sounds complex, right? But it's just about understanding a method called discounted cash flow analysis, which is the star of our video today. In simpler terms, this means that a business's real value can be found by summing up what all its future earnings would be worth if we had them right now. With this in mind, it's clear that if we're thinking of buying into this moneymaker, we need two important pieces of information. Firstly, we need to know how much money the business will make for us down the line. And secondly, we need to figure out what that future money is worth in today's terms. To make big investments, it's essential to know these top tips right away and focus on building good relationships with cash flow. First, we need to check out the money a company is bringing in for its owners, also known as earnings. So how much do the owners earn? It's the money left over after you take out costs for things like repairs and keeping everything running smoothly. You find this as the final line in the first part of the cash flow statement, and it's called the operating cash flow, which is the cash a business is truly making. Figuring out how much a company spends to keep its earnings stable, also known as capital expenditure for maintenance, is a bit trickier. That's because while companies have to tell us how much they spent overall on things like making their operations better, called total capital expenditure, they don't have to separate that number into parts for growth and maintenance. Only a few businesses let us know their repair and upkeep costs in their yearly reports. If a company doesn't share that, you can start with what's called free cash flow, which is the operating cash flow minus total capital expenditure. This might make our calculation a bit safer, but it might also be a tiny bit inaccurate. Let's make this clearer with an example. Let's imagine that in 2016, we bought some stock in Apple. After taking out the total capital expenditures of $12.734 billion, Apple had a free cash flow of $53.09 billion. Now we're getting somewhere. So what's next? Let's say we're going to buy this company now, hold on to it for 10 years, and then sell it off. That means we'll spend some cash up front to buy it, then enjoy regular earnings from the company for the next 10 years. After that, we can sell it and pocket a big lump sum. We know the company is bringing in $53.09 billion for its owners annually. We can use that to guess their future earnings by figuring out how much the company might grow. Looking at Apple's past decade as an example, their earnings have grown between 20% and 30% each year until 2016. This is where things get tricky. Your guess about growth can make the results say almost anything. You have to be honest with yourself about how much you think your business can grow over the next 10 years. If you're too optimistic, you might think that a company like Tesla is cheap at any price, even with a 50% growth every year. Instead, choose a growth rate based on a careful look at the company, and if you're not sure, it's better to be cautious. For Apple, we could guess a 20%, 30%, or even 40% yearly growth. But given that Apple is one of the biggest tech companies in the world, I'd be pretty happy with a 10% growth each year for the next decade, and a 15% growth would be a bonus. To be safe, let's go with the 10%. So what happens next? Alright, let's dive into something cool. Our goal here is to bump up our free money, or free cash flow, by 10% each year for the next 10 years. Then we're going to guess the company's sell-off price. Basically what we think we can sell the whole company for after a decade. Back in 2016, Apple was going for about 10 times its free cash flow. Using that as a benchmark, we're aiming to sell Apple for 10 times our free cash flow in a decade. What's next? We multiply the cash flow in year 10 by 10. That means we're predicting Apple's free cash flow to hit a whopping $137.7 billion in year 10. So, if we sell Apple at 10 times that, we're looking at a huge figure, $1.377 trillion. Impressive, isn't it? But we're not done yet. We figured out our future earnings and the company's future worth. But those future bucks aren't as valuable today because we're still years away from pocketing them. It's like the old saying, a dollar today is worth more than a dollar tomorrow. Why? Because if we had that money now, we could invest it and have a much bigger pile by the time those future earnings actually roll in. So we need to consider this. To adjust for this, I'll use a discount that considers a 15% annual return. Sure, you could just aim for 10%, but that's what an index fund gets you on average, so you might as well not bother. To reach our final number, we divide our future cash flow by 1.15. That's the 15%. Then we multiply that by the number of years that pass. We do the same for our sell-off price. Once we've done all that, we've got the current value of all the future cash we'll rake in. Pretty cool, right? Adding up all these cash flows gives us an intrinsic value, which adds up to $759.53 billion. So, according to the latest data from 2016, if we grew the business by 10% every year, Apple's true value would have been $759.53 billion. But when I ran the numbers with a 15% growth, the true value jumped to $1.062 trillion. So, using this method in 2016, one could have figured out that the real value of Apple was somewhere between these two numbers. Now, how does all this play out? Well, there's more to this fun number game. There are a few more steps. Think of it like this. If you were house shopping and you thought a house was worth $500,000, then you found $100,000 buried in the backyard, how much would you pay now? Of course, you'd pay up to $600,000, right? Well, the same thing happens with big companies. They're selling more than just a business. They're selling a treasure chest of money too. So, what you need to do is take a look at the company's financial records to see how much treasure they've got, and then you can add that onto your price. According to the 2016 records, Apple had about $20.48 billion in cash and another $46.671 billion in other quick-to-sell assets. Add that $67 billion to our earlier calculation and we get a new range of $826.7 billion to $1.129 trillion. This takes us to the penultimate step. But what's that? Wait for it. And now, drum roll, please. We come to an essential piece of the puzzle, the safety margin. How sure are we that our little prediction will play out exactly as we think in the real world? 0. It's not going to happen exactly as planned. So, since we're estimating, we throw in a little extra space for mistakes. A newbie in investing should look for a safety margin of around 50%. If you're a seasoned player, you might be comfortable with a 30% safety margin. Someone as rich as Warren Buffett might even be okay with less. But if you think the value is between $826 billion and $1.13 trillion, remember, you're probably off and need to adjust for that. A 30% safety net brings our range down to about $580, $790 billion. If you could have bought Apple at the end of 2016 for that price, you'd have pretty much assured yourself a 15% return each year. But how did Apple's real market cap in 2016 stack up against our numbers? Surprise! It was $609 billion. That's pretty low for our 30% safety net, isn't that something? But wait, there's more. Guess who was buying Apple shares in 2016? Investment wizard Warren Buffett. Why? Because this is how the investing big guns determine a company's value. It's called a discounted cash flow analysis. If you enjoyed this video, make sure to like and subscribe.